Hello, everyone. I'm Ray Lim at Korea Institute of Finance. On behalf of our institute, I first like to thank the audience for participating in our global talk with Professor Stijin Claessens. Please understand that we are holding our session online due to global outbreak of coronavirus. But I fully expect to have a productive discussion nonetheless. We would first have Professor Stijin Claessens talk about the digital economy and bank's business model, and then have a further discussion with our panel. For our panel, we have Director Ja Hong-min of Financial Stability Department at Bank of Korea, and several renowned senior research fellows at our institute. Professor Stijin Claessens' reputation precedes him. He represents the BIS in Financial Stability Board, the Basel Committee on Banking Supervision, and the G20. He's been also leading policy-based analyses of financial sector issues at the BIS. He previously worked at the World Bank and the IMF. Now I hand over the mic to Professor Claessens, and please give him a round of applause.
Thank you very much, and thank you for inviting me to give this talk. It's a pleasure to be here, although it's online. I have visited Korea many times, and I enjoy very much interacting with your colleagues at the KIF. I do remember going back a long time ago to the Asia crisis when I learned a lot from you. So I hope I can share some insights from my recent work, which is joined with a number of colleagues. It's a report put out by the Barcelona Center, IESE, on banking business models in light of COVID. I'll present chapter 3 of the report, which talks specifically on the digital economy and the effects on the bank business models. Let me share the screen and the slides that I have here for you. So this chapter, as I said, is part of this report. I should say they're not necessarily the views of the BIS. Let me start with the motivation. I think is very obvious here. Technology is changing rapidly the financial service provision, particularly through new entrants. And in many ways, COVID, the pandemic has accelerated that. We have to work online, and people are worried about even cash usage. So the digitalization is affecting the banking sector even more than other sectors, perhaps. What I want to talk about a little bit about what we know of how technology and financial services affect bank business models. I think it's important here to think of different services, and the effect on revenue and profits will vary accordingly. It's not a general statement. But I will focus a lot on the entry of new financial service providers, the fintech, the big techs, notably, and what the impact may be on banks. And lastly, I will end up with some policy issues that will come to the fore as a result, and ask whether some of these things can be solved. Is it a triology or a trilemma? We have to make some trade-offs here because we cannot solve everything. Let me start by just recapping quickly what could be the effect of financial technology on financial services. And it's fairly obvious, of course, that technology has been around for quite a while, and in many ways financial services have led the way. One can think of the telegraph that was used mostly for financial services a few centuries ago as an innovation, and the ATM and other ones. In that sense, financial services has led the way in many ways. And the purpose, of course, is to lower cost, but also to add new services, and that way expand the frontier and create a consumer surplus. That can come from existing customers, but also from extending supply. We can add more customers, give more access, more financial inclusion. I think these channels are fairly well known and been going on for a long time. I think the big change recently is that we've seen entry and exit based on technology only, and that is changing the competition. That's really altering the revenue and profit distribution around the world, and where does the profit end up is not necessarily with incumbents, but is moving away from the incumbents. And related to that point is the overall market structure. This technology comes with a lot of fixed costs, but also with high network externalities. So industrial organization of a market can change, and we've seen it quite rapidly in a number of markets. Now, how do we observe these changes? Well, of course, prices will go down, and we've seen that. And this is an ongoing trend again. If you think of online brokerage, this is not something that is recent. It's been pushing down prices for a long time, and this has benefited the consumers quite a bit, but not always. There's also some scope where technology doesn't always benefit the user. I'm thinking of discrimination, cream skimming, in which the data that are available to these new users can actually extract surplus that goes to the provider rather than the consumer. Nevertheless, the overall, of course, the benefits have been there. The other thing is on quantity. I mean, we typically tend to think technology expanding the frontier means more quantity. Yes and no. I mean, in some sense, we can tailor with these new technologies, and particularly with the data part, services better. And that might mean we may not need as many services. And I always use this example of an agent, a person who wants a certain basket of goods, of services, including financial services. He or she could be much better served with the new technologies by giving them one product, an insurance product exactly tailored to his circumstances, or a pension product tailored to his or her circumstances. But what we do know is that there's a lot of migration away from existing providers. What does it end up meaning? Well, the cost and profits are going to be less for the incumbents, largely because of the market structure changes. Now, where is it showing up mostly? This is a slide that gives you kind of a breakdown of earnings by different banking services. Now that we know from first principles, we can allocate services in different way. We can think of maturity transformation, information processing, risk management, but that's very hard to document in real data. So we typically look at these more functional services as I list them here. And you see then there that in terms of the ones that are going to be most affected, likely retail payments and wholesale payments is a very big one. And it has a large global income stream of about 700 billion. Retail banking being next, and then maybe institutional banking. But there are other sectors of the financial services that are probably not so easily affected by these new technological changes. Where have you seen it? Well, obviously, as you know very clearly in payments, there's a lot of scope for network externalities. So the winner takes it all can go very rapidly, as we've seen in China in a number of years. Those two providers have taken 80% or so of the retail payment markets. It relates to this scope for network externalities. It's also, of course, the quality of services that they offer that was superior. When it comes to credit, it's a little slower. It relates a lot to the country's regulatory and competitive environment, and I will come back to that. Deposits to date have been the least and the last affected, and I think that's an important point here. It requires much trust and regulatory know-how. Insurance is a little bit in the property and casualty, but not as much in terms of life insurance. Just to expand on this, where the banks have been operating and where we have seen the impact. We see a lot of collaboration recently with fintechs. The initial thought was fintech is going to drive out many banks, but as it turned out that there's clearly a collaboration possible there. On the banking side, it's a useful way to buy up technology to help the customers get the customer-friendly services. But it's also because the fintechs don't always have the name brand or the knowledge. But nevertheless, in the end, of course, it is going to be a profit-sharing arrangement in which the existing incumbent banks do end up losing some of their profit. Now, how does it occur? It varies a lot by market. This is not something where the fintech has a universal footprint. In the US, for example, mortgages are now dominated by fintechs, where you can really get a rocket mortgage in a very short period of time. And the European context, it's maybe more payments. In emerging markets, it's about payments and credit. It really depends a lot on institutional characteristics. The US example is because the GCs, the government-sponsored enterprises, buy up mortgages. So it's really, you don't need a balance sheet, you just need a service that can screen and process these mortgage applications. And that's largely the role that these new providers function. Do the effects show up in profitability? Yes, to some extent. The technology itself that has been there for a while is hard to detect in terms of profitability. It's a slow-moving trend. We do see, however, some earnings really being diminished as a result of the technological and the entry. Particularly for those weaker and smaller banks. After all, these, as I mentioned, these outlays are very large. And in the current environment, this is a big challenge with digitalization happening all around us, with interest rates being low and activity also being challenged. These banks may be fighting what I call a losing battle if they're too small to be able to invest sufficiently to keep up with the new competition. What the bigger change and maybe threat as such is the big techs. To date, the effects are not that large yet, but it's clear that the Alibabas, Amazons, and the like of the world, the big techs, have an ability to enter this market very quickly. We see that in payments, that's the Chinese example. We see it in credit to some extent. Amazon is one example where it's offering credit to its suppliers and its customers using all of its data that it has. And clearly that is something that can be expanded very, very easily given the network that they do have. As I mentioned, insurance a little too late. So this big tech business entry could be much more transformational than the fintech one. The fintech being the more collaborative version, the big tech being more the threat. That also is, of course, clear from the market capitalization of the big techs, which exceeds many banking systems at the moment. They're all in, several of them are in the $1 trillion market capitalization, and that really is much, much greater than many banking systems combined. We analyzed it in a big report. I think you may have seen it. It came out last year, the year before last, on data network externalities and activities. And the key point there was that these data and network externalities reinforce themselves because it allows a big tech to move from one activity into another activity at low cost, maybe cross-subsidize it initially and then move on. What is the actual presence at the moment? Well, we see this is a chart that's a database that's being updated continuously. This is only 2018 data, so the current situation is already quite different probably. But you see that the fintech and big tech combined represents still a small in terms of dollar values around the world. The largest is China, $414 next to the US. But Korea is very close, it's $165 per capita. The big difference here across the countries is also the percentage that is represented by big tech versus other fintech. So the US, as I mentioned, is really a fintech story about US mortgages and the like, whereas in let's say China is a lot more big tech because the credit is being provided by the Alibabas and the like of the world. So a lot of country differences. Important to keep in mind why these differences arise. The analysis we did was that it is clear that big tech is much more sensitive to regulations. So the sensitivity is there in fintech as well, but big tech will respond to a much more loose regulatory framework and then will enter much more rapidly compared to other financial institutions. And similar, the market structure, concentrated market structure with a relatively high margins is more conducive for big tech entry than for fintech entry. Having said that, there's, as I mentioned already, there's a lot of differences across countries. A lot of it has to do with these things that are difficult to document, advantages of data, these network externalities, how quickly do the incumbents adapt. Nevertheless, the bottom line, I think, for banks' business model is clear. There's much value at risk here. This digitalization is increasing, accelerating because of the virus. For large banks, it's really overcoming their legacy and legacy systems versus the time that they still have left before the big techs, in some sense, enter even more so. For the small banks, I'm worried about the scale of investment. It is large and not always feasible. We also see that the regulation can make a big difference. Open banking was introduced in several countries, European Union, others as well. It was meant to level the playing field in terms of creating more competition for banks. But now with the big techs having so much more data, that may have actually created an asymmetry in which the banks are at a disadvantage. We've seen global competition in the form of stable coins and the like on the horizon. So that all means, in particular, given where we are in the financial and business cycle, that banks have to adjust rapidly, and it may be late for some. I don't hope that I have to conclude that regulation is the bank's key comparative advantage. I don't think that's the only one they have, but they do have to challenge themselves more going forward. There are policy issues, and we can come back to those later. I'd like to summarize these in the form of this triangle, where I see 3 dimensions that we know to some extent, but there are several new ones. The first one is a traditional stability-competition trade-off. We know that too much competition may lead to instability, but then competition is good for efficiency. So we do have a trade-off there. But with the new industrial organization of big techs, that has to change quite a bit how we think about that. The other trade-offs are quite different from the traditional ones, and they center much around data. And I think here particularly about the trade-off between privacy and efficiency. It's very easy to have an efficient system if you were to share a lot of your data because you may get good services. But nevertheless, there is a trade-off because there may be misuse of that data and the customer actually doesn't benefit from it. So efficiency has some disadvantages. At the same time, it's clear completely privacy is not a way for us to operate in the new economy. You do have to share some information. So you as a customer have to have a perspective on it. Well, what do you want to share? What is useful? And lastly, from a regulatory stability point of view, we always had this trade-off between privacy and stability and integrity. The supervisors need to know the data at the bank's balance sheets. The money laundering authorities need to know something about the individual making transactions. Now here, this is coming even more to the fore, of course, because we have these continuous new products being offered that may challenge the existing paradigm, and we have to adapt that. So going forward, I think there are policy areas that we really need to look at closely. Our old paradigms may have to adjust. We used to think very much as an activity-based approach and level playing field as being the paradigm for financial service provision when it comes to new entrants. But it may not be sufficient. It may not be enough for the new big techs and fintechs that enter. Clearly, competition policy has to adapt quite a lot. I think there are examples from outside finance. Think, for example, of the telecommunication industries, where there's a lot of platform economics, as I call it, that acknowledges the network externalities and that adapts the policies, the competition policies accordingly. One can go more beyond that and think about access policies and even separating banking and commerce as a way of treating the new paradigm in this field. But the big challenge really is going to be on the use of data. I mean, how do we think of data? Where do we get efficiency gains by balancing privacy? And that's not the only, but an important element. I think that really ends with a call for action in some sense on the economics of data. That's not a field only for finance, of course, but it is something that we really have to do more of in order to be able to address this new sector more productively. So let me stop here.
Thank you for your talk, Professor. Now let us delve further into the issues Professor Claessens just raised. I believe our panel has several questions, but let me go first. Responding to big tech's innovation in payment, the traditional deposit-taking business are evolving too, for instance, into electronic wallet. And the loan services are increasingly taken by non-banking institutions. And my questions are, would such trend be a temporary thing or permanent? Or how should the legacy banks respond to the squeezed margin and market share? And could the non-interest income become the alternative of deposit loan services? And finally, what do you think the market structure in banking industry will be in the future after possible consolidation? Thank you.
Well, thank you. Those are very good questions, and they're not easy to answer, and there are many people are struggling with it. It's an active field also for the consultants that are looking at various models. It's still clear to me that this is a permanent challenge. This is not going to be just a one-time only, unless we see regulatory backlash somewhere. I mean, which I can't exclude, but nevertheless, I think that's not the norm. And secondly, I think banks have been facing this for some time. I've been surprised how slow sometimes banks are in taking up technology. It's been, like I said, a trend that could have been anticipated 10, 20 years ago. Many of the things that we do now is not particularly new, whether it's an online banking or online brokerage. The scale and the scope has increased because the data part of it has improved, and the challenge from outside has improved as well. So banks have no choice. Can they do it better? I think they can. I mean, there's still a lot of silo thinking in banking, I think, where products are being provided individually without using the data at the customer side and being really customer oriented. So that, I think, would be the core challenge for banks, because the business models of big techs is very different, right? It starts with the customer and the individual component, and then the products are being tailored accordingly, and it's much more demand-oriented provision rather than a supply-oriented provision. Having said that, there are services where banks clearly still have an important role, and we can come back to it, but really asset management and wealth management is something that many of the big techs will not easily get into it. It requires a much more level of sophistication. So I think there are some non-interest income streams that can be expanded and that can be improved for banks. But I think the core point is nevertheless pushing the technology frontier to the limit. But it's getting really rid of paperwork, getting rid of even branches and customers and consumer interface that are very expensive. And that many, particularly newer customers, of course, don't even ask for and want anymore. So I was always struck by my bank. A number of years I lived in the Netherlands, and the bank customer agent would keep calling me to come into the bank to talk about banking business. He says, well, why would I want to do that? And clearly the customer agent was not having anything to do and wanted to talk to it. So I think there are a lot of efficiency gains still to be gotten. So I think that the structure of the banking system will change too. I think for many small banks, they will see themselves put under pressure. We have to allow for the consolidation then to happen. And I think that's, don't know enough about Korea, but there are many markets where there are too many banks, but there is resistance politically and otherwise for the smaller banks to be consolidated and taken over. It has to do with the ownership structure that's not traded in the market. It's held by foundations and other ones. So it's a governance issue as well. In order to break through that would be step number one, to consolidate, because only then do you get the scale, because these investments are not small. We know that large banks, if you take the top JP Morgan of the world, the investment in IT is in the tens of billions of dollars, $10 billion or so. So these numbers are not accessible for small banks, of course. So that would be the starting point as well to see more consolidation. Let me stop here.
Thank you. And
Okay, hello, Professor. I think you've already answered quite a lot here and there in your presentation and in answering the previous question. But as a researcher who's interested in the management of financial institutions, my question to you again is as follows. Let me read what I have here. Big tech driving payment innovation in most countries and the larger share of non-banking services, specialized big techs like in the US or in China, are most likely to diminish the intermediary role of traditional banking institutions. Then, what are the best alternative business model of legacy institutions in the scope of commercial, investment, and universal banking, in your opinion? Thank you.
Thank you, Ms. Gimmer. I think the risk to my mind is sort of in form of cannibalization, in which you have individual pieces of your business as a bank being commoditized, and some of them are already commoditized, and are being picked up by the new providers, the fintechs or the big techs. We see that clearly in payments. It's either to the profit sharing or it's to losing the service completely. And I have already, as I mentioned, see that in online brokerage. So the risk is that we're left with kind of a legacy of a bank that's not much more than a balance sheet and a utility that provides, in some sense, the back office to those other providers that have nibbled and taken away bits and pieces of the business. Well, the banks have to then proactively respond to that and go back to their core value add and say, okay, what is it that we can, besides being trying to mimic the technology, do well? And I think that it always comes down to trust. The banks have the trust that these new providers don't necessarily have. They have the ability to process soft information better. There's still a value of soft information, although we think that everything can be digitalized. I think we will discover that that doesn't work completely. In some sense, COVID has been a good test. We do now all meet online with Zoom and the like, but I think we do sense that there's some lost sensitivity and there's a loss of information there, and banks can, that's just as an example, of course, but banks can process that information better. I would add to that they have the balance sheet. I mean, the balance sheet is not minor here. And if you look at the big techs and the fintechs, they don't put that much balance sheet on the table themselves, right? Now you can argue they don't have to because they can get it somewhere else for free. I think there's a reason too, is that there comes a regulatory cost with it, and a very reasonable cost, because we want to protect the depositor or protect more generally the system, but they don't have the know-how in order to be able to manage that process properly. And I think banks have a great value there in terms of having done that for centuries, of course. So in that context, I think investment banking and universal banking, the two things you mentioned, have a lot of scope still to continue, because it is about trust in both businesses very much. It's about reputation. It is about balance sheet acting very quickly. It's also about being able to have what we could call an elastic balance sheet. In times of needs, banks can extend their balance sheets relatively quickly. This is not so feasible for non-banks because they have to go out in the market and raise funds. And banks, by issuing deposits, can in some sense do it overnight on its own accord. Plus, it's backed up by the central bank. All of that means that big deals, as in investment banking, are very useful. That does mean that, of course, these other services you're going to see migrate away from it. Now, they're not commodity services, and there are commodity services, but they're still profitable. So whether banks will be able to maintain that's a challenge. I think it's about running against time. If you see all your profit disappear, then you cannot operate as a bank anymore. So you really have to accelerate your technological transformation very much in the coming years.
Okay. Hi. I am Jung Woo-soo from KIF. I have a quick question. The separation of banking and commerce that you just mentioned briefly has been a strong norm in financial regulation in Korea. And that has been a case in Korea, especially because the chaebol or large conglomerates may cause financial instability if they own banking institutions. But recently, the commercial platforms have been extending their business into the financial services as a result of technological advances. Then, do you think the separation of banking and commerce should still be one of the key norms or regulatory paradigm, in your word, in financial regulation? Or what could be the modified approach for achieving the balance between stability and efficiency?
Well, thank you for the question. And I do remember the intense discussions in '98 when I was working for the World Bank with yourself as well at the KIF about the banking versus commerce links. I think this issue, there's a lot of differences here. So everybody has different solutions. So maybe let me step back and approach it first from big principles. I think the big techs, of course, have operated across a number of businesses, and finance is actually a relatively small part of that. So the platform that they have may require competition policy interventions, regardless of whether they are active in finance or not. That's clearly already a debate that's ongoing in countries. You see let's say in the US, Congress getting more active, proactive in terms of asking questions. European Competition Policy Agency has been quite active in terms of limiting the big techs in their non-financial services. I think that should be the starting point when we try to address this. How much does the competition policy agent do in terms of reducing some of those negative effects given the externalities that they exist? Second, I would reiterate the argument I made about level playing field. Level playing field, in my definition, is looking at activity by activity and saying, well, do the big techs have some advantage relative to the financial services because they're not regulated as closely or as tightly? And there are a lot of consumer protection rules that we'd want to see regulated exactly the same. AML is another example where money laundering rules should be the same for big techs as for banks, of course. I think those two things, we're not there yet. The first debate is ongoing. The second about level playing field is still something where we have applied more carefully. We've done it in some extent, but I don't think we're all the way there yet. Think of consumer protection, some of the new big techs. I don't think it's the same investor and consumer protection as we've seen somewhere else. Of course, then when it comes to more prudential regulation, which is really where it comes in terms of deposits and the like, then it becomes closer to banking and linked commerce. Because then what the problem, of course, typically is in the link between banking and commerce is the misuse of balance sheets, right? So the non-banks has access to the bank's balance sheet, and for that reason ends up being not using it properly. There are answers to that. Narrow banking is an extreme answer. Then you really limit the activity of the banking. I think that's a bigger one. The banking versus commerce ownership links is what you have in Korea. I think is a very good one for many countries. It's a very clear red line. It's not something that one can debate that easily, but it's very clearly drawn in the line. And it creates a lot of clarity. That would mean that the big techs would have to establish separate subsidiaries and separate activities in the holding company structure where it's clearly aligned. And I see some of that already happening, including in emerging markets, that the big techs in China just recently have been asked to adopt that holding company structure. I think it's helpful. It's not sufficient. I mean, you really need to think still about banking and commerce links that are more indirect that exist. but nevertheless, that is a way to do it. And you can go more granular than a banking commerce prohibition and talk about individual activities that banks can and cannot do, and vice versa, what big techs can and cannot do. It's kind of a version of a Volcker rule and saying, well, if you're a bank, you can only do X or Y. It's not going as far as a narrow banking. I think all of these things are doable, and I see trends in that way. I mentioned China. There's some talk in the European Union as well, how to regulate big techs for the financial services. The US is also thinking that way. Having said that, I think the big question is still the treatment of data, and we can come back to that. If we don't separate the data exchanges properly, then of course big techs will always have an advantage. So we need to go back to, okay, who is the owner of data? What is the privacy part, private part of it? What can be shared? How can it be shared across an institution or within an institution? And how can it be shared, even for the matter, across borders? So that data issue is more general. It goes back to the big tech regulation, but that should be in some sense the starting point. If we don't have that defined properly, we're going to keep ignoring the big issue on the table. I think that's where we have to spend some more time on that.
Okay, thanks very much. My question probably related to the previous questions as well. When we think of digital economy, most people talking about data, but data itself doesn't mean actually nothing. It means something privacy, something transaction data. But certainly, a lot of questions are coming from the data regulations. And recently in Korean banks, really asking some more level playing field in the data sharing, because big platforms actually already accumulate a lot of data, maybe just financial data, also non-financial data. So what is really better regulations in terms of data sharing schemes? Probably data, maybe including private information as well, also financial data as well. So what is the best way of doing it? Whether we have a more general approaches like computational services have taken, or we have more specific regulations on financial services. When I say financial services, when these big platforms are having or accumulated some of our financial data, which can be used for the risk management or controlling the balance sheets by the financial institutions. Thank you.
Thank you for the question. It's a very good, and I think I alluded to it already before. It's not an easy, but I think one has to start from the basics, from what are the economics of data. So what is it that data do in terms of market structure, in terms of competition, in terms of benefit? So my triangle is one attempt to it. And even that triangle, I think, misses in some sense many of the key points, which the data vary a lot, right? It's not that all data are necessarily a problem, but some data are more a problem than other problems. So I always start from there's need for more granularity. Data and granularity go together, of course, but think of data that are very private, that you want to keep your health records. You can share it with some people, with your doctors, but not with everybody else. There are other data that you don't care, that you actually want to share. I mean, your publications online, or your activities online, or even social things that you want to share. So that should be for free, and that's fine. And then there are data that are useful for somebody else, which is maybe, I don't know, your Google browsing history, that in some sense you're not getting paid for, but nevertheless it's of a value to a third party because they use it with the other data. So that data should in some sense you should sell it rather than they get it for free. And then there may be data that you would want to temporarily rent, where you give the data to your bank and say, well, can you give me a loan? It's an anonymous data, so I'm actually shopping it around with some other banks as well to get a mortgage offer. Now, unless we get more granular with that data discussion, I think it's becoming too amorphous kind of a discussion for addressing big techs as well. If we have that sorted out, where are the externalities, where are the market failures, we have to then think about what technology can do to make that data sharing more productive. And I think there are some examples. Again, I don't know Korea's current thinking, but I've seen it in Singapore, I've seen it to some extent in India, where you really have a data platform that is a private-public partnership, where that data is maintained in a unique and secure way, and then made available in this layered approach to different providers, with the idea that some is beneficial to you, but some is beneficial to the other side. If you can do that, now that's partly a technology question. It's also a lot of legal issues, of course. Is it possible? I'm always by nature an optimist, so, but nevertheless, think of it. If we've solved a lot of things, you can now register yourself not to get calls for marketing competitions, marketing agents, so your phone doesn't ring all the time. It's somebody trying to sell something to you. We can do the same thing. We can have our IP number or a name listed in some registry, where at the beginning of the year says, well, I don't want any of this data to be shared with the following companies, or I don't want this to be shared in principle. And that is your default. So whenever you go online, whether with one device or another device, all that is already on record. And that is the law in some sense of the sharing of the information. It's a technological solution that maybe is simplistic, but nevertheless, something that we could pursue. And like I said, the Singapore and India example, they have done it. They've introduced, for example, the concept of a data steward, and saying, well, even if you don't want to do it yourself, you can give it to a third party, a trusted party that's recognized and approved. And this party can then share the data according to your desires. Once we have that a little bit more worked out, I think we have a better chance to regulate the big techs as well, get a better competition. Then we can take it to the financial services. I think to start with the financial services only is not necessarily going to solve this problem. It's too big for the financial services anyhow to solve, so it requires a bigger level. And then you don't want to create an unlevel playing field anyhow. Having said that, there will be some special issues for privacy and financial secrecy, confidentiality that we have to include. But I wouldn't start necessarily on the financial side. I would include it in this bigger discussion, for which I think there are some examples now. My main fear is that the economics of data is moving too slow, and that the legislation will look at this quite differently, and they may think much more in legalistic and privacy terms. And then you get kind of corner solutions where he says, well, no data is shared whatsoever, which is often the case in European countries, which is hurting the consumer, or there's no answer from the legislation and data is available, which is a little bit more in the US, for free, but actually that doesn't benefit in the end the consumer, but it goes more to the big techs, this consumer surplus. So to find the balance means somewhat of an educational effort to the legislator, that they come up with the right laws that make this data a little bit less amorphous and more what I call granular. What do you share? What do you not share? Okay, and how can you support it with data laws and the like? A big agenda, not easy, but I wouldn't start with the financial sector only. I would take it as a big perspective.
Very much.
And I believe that the Review Institute Director Min has a question. If you have one, please go ahead.
Okay, can you hear me?
Yes.
Okay.
How are you?
honestly, I didn't know that the discussions were more about the fintech and big tech, but anyway, because these topics are also the topics which the central banks are very much interested in from the perspective of financial stability. I have a very brief comment, which is that it is about how we go about regulating big techs or fintechs, and we are provided by such a, for example, BIS, the basic principle, like as you said earlier, same activity, same regulation, or same risk, same regulation. But it is very hard to actually apply that principle to big techs or fintechs, because the bank's regulation, the bank's regulations are based on a unifying and internationally coordinated framework, and the component of each cannot be just separated and treated as such, and cannot easily be adopted to regulate big tech or fintechs, right? So my request to BIS is to identify some best practices for the main areas of big tech or fintech businesses, and then we could share the best practices, and then rather than starting from a very abstract and basic principle, we could build the cases. That is my first comment. And the second one is because I thought that the discussions was about the banking business amid COVID crisis or after COVID crisis. So this is a bit, I'm worried this is a bit out of line of from the discussion here. But anyway, because I prepared, if I may, I will ask the question. Our concern, the central bank, of course the government too. In these times, especially in Korea, the banks are doing quite well despite the COVID crisis. And for example, delinquency rate are historically low levels, and the banks are doing very well in terms of profits. But we all know that there's still something wrong with the economy, and there's some huge potential risks lying behind under the surface. So how should we handle these hidden risks and the potential risks? How do we measure the risk correctly? And what are the risks and implications for the global banking industry, given that the leading indicators are getting better and better, especially in the asset market, but the other areas such as Main Street consumption and service sectors are still in struggle. So my question is, how do we actually measure the real risk we are facing here?
Yes. No, thank you very much, Mr. Min. Just on your first point, I agree completely that it's easy to talk in generalities, but then in the end, one has to go down to specifics. There's some work at the BIS. Our colleague Fernando Restoy came out with a paper last week on how to regulate big techs in light of some of the issues that I mentioned, how difficult it is to apply a level playing field and how much challenges we can get. Because he advocates very much an entity-based approach, not an activity-based approach, or at least he's saying it's not sufficient. And then once you move to entity in the big tech, it's a big entity, of course. So he has some examples as well, and there's some other papers that if you want, I can provide you that get more specific. Having said that, I mean, I think regulation, one wants to start from first principles, because it's easy to look at the symptom and then before one knows, one has a lot of regulation. But in the end, the fundamental issues, as I mentioned, are quite different and new for us. This really goes back to this data. So I don't think we can avoid having a hard look at what data means for regulating new, because we can say, okay, it's finance specific, and but big tech has issues more generally, right? Consumer surpluses, like I said, it's not always going to the surplus don't always go to the consumer. On your issue of what the banking system may face going forward, I mean, I understand the question. I'm not so sure it's that necessarily different or difficult from what we have seen in the past. And I'm actually often using the Korean example, sorry, that when you had your crisis, which was a lot of corporate sector crisis as well, right, and the chaebols, one can go back through that corporate sector and say, okay, what is the profitability? Which sectors are going to be more exposed, which have received more financing? Where is the leverage increasing? Where is the profitability going down? One can do scenarios. On the basis, one can come with an aggregate loss number that is a reasonable proxy for what one may get. One has to do scenarios. The future is uncertain, of course. So in that sense, there's stress on, but starting from the corporate side and building it up, and you have very good data, of course, one can get a long way. And then in terms of tackling this issue, and again, examples exist. It's less often that we have a corporate sector crisis. We typically have more of a banking liability-driven crisis where there's a run or some other financial distress. But in this case, we know it's going to start at the corporate sector. Banks are, as you mentioned, relatively strong. Profit and capitalization has increased since the GFC. So, and the corporate sector, we know, is it why we're going to run into trouble? Is it the bankruptcy system that cannot handle it? Is it too many, some congestion? Or is it there's some externalities because there's a supply chain that has a big firm in between that's going to go bankrupt? I think in some sense we have an easier way to diagnose the issue and as a consequence lead to come up with certain solutions. Then the typical question arises, do we want a centralized approach with an asset management company that takes off certain sectors? I don't know, the retail sector may have a lot more distress. We want to take the real estate of the retail sector into some AMC, just give an example. Or do we want a more decentralized approach? I think many of the reasons why these approaches can work or not work are known. Design will vary a lot from country to country, but we should get ready for it. It's a predictable problem in some sense, right? And but unfortunately, I'm on the Basel Committee, and many of the supervisors there are like, yeah, I don't know. I'm surprised we haven't seen the problem yet. They do understand that there is an issue, but they don't see it in the numbers because interest rates are low, moratorium are there, fiscal support. But I think that should not be an excuse for getting ready for what will come down the road, because we don't want to be in this situation a year from now and then suddenly the fiscal support disappears and then we're going to run out of it. I'm not saying fiscal support shouldn't be there in a targeted way, but it cannot be there in a blanket way once we have the vaccine out and the crisis under control. So in that sense, the speed at which you do this, of course, is partly a macroeconomic question. If you pull the plug too quickly, you may get the distress to appear too rapidly. You also may get demand to collapse. If you wait too long, you may actually get the opposite result. I mean, we're going to get a relatively quick recovery in consumption because of the pent-up demand is very large, right? So financial conditions which are very loose now, but may appear even too loose if inflation goes up because of the increase in demand and the economy is really taking off later in the year. So we have to anticipate a package of reform where we say we're moving away from general support to more targeted support. We're addressing the corporate sector problems, while in the meantime getting slowly out of our support measures that we have had in place for quite a while now. That's a delicate balance to do, particularly since leverage is high in many countries. I know in Korea household leverage is high, so it's not like you can suddenly remove accommodation because that would create some other issues. So I'm sympathizing with the Bank of Korea and other central banks, but I'm more cognizance that we can analyze some of these problems ahead of time and hopefully then get ready for them.
Okay.
Let me stop here.
Thank you, Professor, and the panelists.